Hello, I'm Darius from Fund Caliber, and today I'm delighted to be joined by Jim Leaviss, who is the manager of the M&G Global Macro Bond Fund, also a senior member of the highly renowned M&G fixed income team. Jim, how are you?
Good, thank you. How are you?
Yeah, not too bad in these strange times we live in. Jim, let's start with the US. There's been strong policy intervention following the pandemic, and US central bank now moving its inflation target. What does that mean for bonds?
Yeah, as you say, at Jackson Hole, which is the big meeting of all the global central banks that happened 3 weeks ago or so, we had the chairman of the Federal Reserve, Jay Powell, come out and say, look, we've been targeting 2% inflation for years and years as the Federal Reserve. From now on, though, we're going to say that we will target a higher level of inflation than 2% if we've had lower inflation in the past. So basically they're saying bygones are not bygones. We can't ignore the fact that we had deflation or zero levels of inflation during the pandemic or at other times of weak economic growth. So if we've been running at 1% inflation, then perhaps we can run at 2.5% inflation in future years. And obviously for a bond investor, inflation is your great enemy of owning bonds. Inflation erodes the value of your coupons and your repayment at the end when you buy a bond. So if the Fed is genuinely going to be overshooting its old inflation target on a systematic basis, that is certainly something that bond fund investors need to be worried about. So that's point one. But point two is the Fed and indeed all central banks, including the European Central Bank and the Bank of England, have been trying to get to 2% inflation for a decade now, really, since the global financial crisis, and they haven't been able to do it. Bank of Japan's had 20 years of zero inflation. So the question is, it's all very well to say that you're going to be targeting 2.5% as the Federal Reserve, but if you haven't even been able to hit 2%, it may be a fairly meaningless, empty thing to say.
And you touched on Japan there, Jim. They've also recently had a change in leadership. Is there anything early that maybe you've spotted in policy and any impact then on your fund? Because it is a truly global fund and you can invest or not invest in those markets as well.
Yeah, I've always liked owning Japanese yen assets in my global fund for the simple reason that they generally behave really well at times of economic trouble or at geopolitical risk. So whenever you've had threats of wars or pandemics or market crashes, the Japanese yen does very, very well. So I still want to own Japanese yen in my fund. You know, it just acts as a really good stabilizer and as something that will do well if my corporate bonds have difficulty or if my emerging market bonds get into difficulty. So I like them fundamentally. You're right, there's been a changing of the guard. Abe, who's been, I think, Japan's longest serving prime minister, is ill. So he's stepping down. Abe, remember, the term people use is Abenomics. And that was really saying we're going to do unlimited amounts of cutting interest rates and quantitative easing. We're going to do huge amounts of fiscal spending. And we're also going to restructure society. So get women back into the workforce, make our labour markets more flexible. So that's Abenomics. The thing is, the person who's going to replace him is very similar to Abe. So we don't expect any great changing of the guard in terms of what you mentioned in terms of a change of those Abenomics policies. So still makes me want to own some Japanese government bonds, still makes me want to own some Japanese yen.
I was just about to ask that. So you actually own a bit of government bond as well as actual physical currency?
Yes, exactly.
Now, if we may turn our attention to another geography, which is our home geography of the UK, clearly globally pandemic has been happening, but more recently Brexit has started to re-enter the headlines and the front pages again. With the Brexit deadline looming, what impact do you see on UK bonds and potentially UK currency as well as we finish 2020 and cross into 2021?
Yeah, I mean, a lot's been going on everywhere apart from in the Brexit negotiations, effectively. You know, there doesn't seem to be any progress, very little prospect of progress. And for markets and businesses, that makes it more likely that we see the so-called no-deal Brexit on the 1st of January next year. And I think when markets realise that, you've seen the pound sell off quite dramatically over the past month or so, and sold off even more when the government minister stood up in Parliament and said that we're going to be breaching international law, because, you know, if people can't trust your international commitments, then that's something that weighs very heavy on demand for your assets, whether that's bonds or the currency and so forth. And just as an aside, we may see this in the US as well. If Donald Trump refuses to leave the White House or implies that he's not going to follow the rule of law there, then I think we'll see quite a negative reaction in US assets too. So there's that going on. And then there's the economic impact of a no-deal Brexit. And to some extent, the market's priced this in, because we know that UK stocks, and UK corporate bonds have generally underperformed the rest of the world, you know, because people expect growth to be weaker. So next year, I think JP Morgan put out some research recently that said a no-deal Brexit would mean that our GDP growth next year would be 3% lower than it would be in the event of some sort of deal. And that's pretty huge. Now, we're going to have some confused economic data anyway, aren't we? So, you know, the pandemic across the world means that actually it's going to be quite hard for people to see what's down to Brexit, what's down to the pandemic, and so forth. So I think to some extent the government may even be relying on that as a kind of bit of a way of, if the government wants a no deal, and I don't know why it would, but if it did, then that would be something that makes it more difficult to see what the impact would be. But yeah, I'd be, as an investor in UK PLC, I'd be worried if we, you know, carried on down this route of not negotiating effectively.
Bad for the currency and potentially continued underperformance on the bonds.
Yes, but on the corporate bonds, for government bonds, the weaker the economic outlook, the more pressure there is on the Bank of England to do something. So actually, you know, a no-deal Brexit might mean, you will have seen a couple of weeks ago that the Bank of England said in its monetary policy meeting, prepare yourself for negative interest rates. Yeah. So it's gone out to asset managers and insurers and banks and said, make sure your computer systems can cope with a negative base rate. So almost the worse the economic news, the more positive that would be for the gilt market to some extent, because we may get, you know, 5-year gilts have got negative yields already in anticipation of the Bank of England moving negative.
Yeah, that was also a bad day for the pound when that that announcement was made by the governor. So then just into the fund itself and a little on positioning, you know, approximately 60% in Govy bonds, 22% investment grade, and then a decent weighting in emerging markets. Maybe we can touch on that, but just maybe a little bit more then on negative yields, and why you're not invested maybe in high yield bond markets so much at the moment.
Yeah, I mean, we did invest heavily in credit, as you know, in March and April, when we had those terrible sell-offs in all risk assets, whether it was equities, high yield, emerging markets, or traditional corporate bonds. The market sold off indiscriminately, such that investment grade, good quality companies, the market was saying that there was almost 20% of those companies would default over the next 5 years. And for high yield bonds, pricing in 40, 50% of them defaulting. So the market priced in so much bad news back then that we were aggressive buyers of that risk, because we thought that, and we saw that the policy response from people like the Bank of England or the ECB was to say, we're going to buy corporate bonds to support those markets. So we took our weightings of corporate bonds and high yield and emerging markets in this fund up to really quite high levels and took advantage of the fantastic yields on offer. But as you know now, we've been in a kind of 6 months, or, you know, ever since the peak, look at my chart here, around about the end of March, ever since then, spreads and yields have been coming down and down and down,
Yeah.
to the extent that they're back to where they were before the pandemic and before lockdown. And so as a result of that, I just think it's time to say, thank you very much. This has been really beneficial to the portfolio. Now I'm not too sure about the future path of the economy or of the pandemic or of the US election. It seems to me that there are still lots of risks out there. And where they were all, there was lots of buffer in the price earlier this year. Now we're kind of, as we say in the world of credit, it's priced to perfection. It's priced as if nothing's going to go wrong. And for me, that's an opportunity to say, I want to own those safe haven assets rather than risky assets again. So emerging markets, you're right, we still own some of those. They have still the highest yields, but again, we've been reducing our emerging market exposure in recent weeks too.
So you were getting paid a bit of extra risk premium for investing in the emerging market debt.
Yes, exactly. They really sold off quite dramatically. So, lots of bonds that were yielding 6, 7, 8% in emerging market land compared to 2 or 3 in investment grade credit in UK or Europe.
Jim, thank you very much. Interesting times behind us and no doubt interesting times ahead. So thank you for your insights and recap on the goings and comings in global bonds. For more information on the M&G Global Macro Bond Fund, please visit fundcaliber.com.